Welcome back, everyone. My name is Carlos. Today is Sunday the 9th, and this is part of our Robinhood Stock Market Watchlist group meeting that we do here on Facebook every weekend, except for holiday weeks. And so one of our goals is to always to look ahead, so that way we can always plan our trades. Because if we fail to plan, we're planning to fail, and that's not us. And so one of the best ways to look into the near future when it comes to volatility and what type of volatility is by looking at the economic reports. And the economic reports just play a huge factor on the entire stock market system. So it only makes sense to start with what affects the stock market the most, and then start working our way down. And so there's several different ways you can look at economic reports, but one of our favorite ways here is by looking at the investing.com website, or they also have an application you can download to your mobile device. But when we're looking at the economic calendar, we need to make sure that we're filtering the right stuff, because otherwise we're just going to get a lot of gibberish. So when we go to the filters part of the economic calendar, we want to clear everything. There's only two things that we need to see. And the first one is the United States. And then down under importance, you'll notice there's a 1 star, 2 stars, and a 3 stars. We want to put hold on here.
Carlos, are you sharing your screen?
I just noticed that. I'm surprised nobody's mentioned anything. There we go. So you should be seeing my screen right now. I apologize, but and a lot of you guys are pretty familiar with the investing.com system, but here you should be able to see it. If you don't, you may have to dig into the software a little bit until you kind of bring it up. But yeah, again, it's very important to filter this stuff so that way we're seeing exactly what we need to see. And by selecting the United States economic information, and then down under importance, we'll see a 1 star, 2 stars, and a 3 stars. So we want to put a check mark under 3 stars, because what we're telling this system is to pull everything that'll have the biggest impact on the United States stock market. So when we click apply, it'll all automatically kind of refresh, but we want to click on this week, so that way we can look ahead for this week. And I'll show you kind of how this works for our advantage. And so normally we don't see economic reports on a Monday or a Friday. That's normal. But sometimes we do, especially if the week is pretty crammed with a lot of scheduled reports. But there's nothing on this Monday, so Monday is going to be kind of like a day where it kind of absorbs weekend news, and that way things kind of settle before we go into Tuesday with a lot of and Wednesday and Thursday with a lot of federal activity. And so with Tuesday we have the short-term energy outlook, and so that just creates some mild volatility in both directions. And so it's nothing really that we need to really try to analyze much, other than the fact that it's just going to provide kind of a mutual volatility. But going into Wednesday and Thursday, now we can kind of predict a little more about which direction it's going to go. Is it going to be bullish, or is it going to be bearish? And so, but it's important that we look at everything here, especially with the time, because when we're looking at on the website, it automatically defaults to the Eastern time zone. So it really depends on where your time zone is. But when you're looking at it on your mobile application or tablet or whatever, it's going to automatically adjust the time to your time zone. So it's important that you know and aware, is it going to be released before the stock market opens or after the stock market opens? So in this case, we have 3 economic reports that are scheduled to be released 1 hour before the stock market opens. So we're going to get a lot of volatility right around that time and right when the stock market opens. And then we have the crude oil inventory levels that is scheduled to be released 1 hour after the stock market opens. And typically the first hour and the last hour of the day are the most volatile times of the day. And so what this is doing right after the stock, or right after the 1 hour after opening, when things usually start to kind of settle, all of a sudden, boom, it's like pouring fuel on the fire, just more extra volatility, to keep the momentum going. But to try to figure out which direction it's going to pick, you have to look at the forecast versus the previous. Is it more than or is it greater than? Because it depends on, what we need. Typically, if it's more than, it's usually bullish, or if it's less than, it's usually bearish. But in some cases, bad news can be good news, and that's where we may see that in this situation. And if you're not sure what these economic reports are, feel free to click on them. A new tab will appear with a small little tiny paragraph that lets you know what it is, and the little paragraph below that lets you know how it will affect the stock market. So for example, and this report that I clicked on is the United States Core Consumer Price Index for the month over month. For last month. That way we kind of see, how well, the economy did and yada yada. But it says right here, the Core Consumer Price Index measures the changes in the price of the goods and services, but excluding food and energy because it has its own little report. The CPI measures price change from the perspective of the consumer, is a key way to measure changes with the in purchasing trends and inflation. And so how it affects that is where it says a higher than expected reading should be taken as a positive or bullish for the United States dollar, while a lower than expected reading should be taken as a negative or bearish for the US dollar, which all affects the stock market. And so when we go back to the report, we can see that we have a June report, plus we have a year over year report, and that's huge because the more rare the economic report is, the more volatile that it's going to provide the stock market. So there's some weekly reports like the crude oil inventory levels that measures how much oil that's stored in our inventories, oil silos or whatever. And these are weekly reports. So they come out every week, kind of giving us an idea of what the levels are, and gives us an idea of are people driving and are they spending fuel and oil and which would help with the rest of the economy because they're going to do shopping. And so this report is weekly, so it's a very mild report, as well as the initial jobless claims, which is the unemployment report. But if we're going with a monthly report, that's going to provide even more volatility, as well as a quarterly report, something that happens only every 3 months. But when you see a yearly report like this, that's probably the most volatile potency that it's going to provide the stock market. So out of every day this week, it's obvious that Wednesday is going to provide the most volatility. So definitely expect that, and it really helps benefit us all when we know what's going to happen before it happens. That way we can utilize different strategies for our benefit. And when it comes to straddling, which is something that I always highly recommend, because it doesn't matter which direction the stock or the stock market goes, as long as it picks a direction, it becomes very profitable. And so when we're having this kind of volatility and you just don't want to take any risk, we always want to straddle no matter what, because it always gives us something to work with rather than picking one direction. So we'll get into that more here in a little bit, but trying to figure out which direction that these are going to go. So again, we want to pay attention to the forecast versus the previous. Is it more than or is it less than? So in this case, with the core CPI month over month for the month of June, the forecast is less than the previous. So typically this should provide bearish characteristics. But again, if we're looking at where a possibility where bad news can be good news, then this would provide bullish characteristics. Now, especially for the yearly, the year-over-year report is also less than the previous, even though the CPI month-over-month for the June is a little more than, but the yearly report holds the most potency of every single economic report this week, and so. We have an interest rate hike scheduled in a couple weeks, which we'll get into that here next, which is very important because these reports is basically what the government and Wall Street and all these other guys are going to see is that when the report comes back less than the previous, they're going to say, okay, us increasing interest rates is working, and so that provides bullish characteristics because they feel like they're doing their job and things are going in the right direction when it comes to the recovery and all that stuff, which we can kind of get into here in a little bit, but Wednesday definitely looks like it's going to be very, very volatile. It could be mixed because there's, most of these are going to be, for the majority of it, it should be bearish. But again, I'm pretty sure we're going to see bad news as good news. But then again, right here, this is a bullish, which could also good news can be bad news. However, the crude oil inventory levels, there's no forecast on it yet. But when we get into pre-market tomorrow, it should automatically populate. So that way we'll see if it's more than or less than. However, just remember that the crude oil inventory levels and the initial jobless claims with the unemployment report, these are the only two reports where we need the numbers down for it to be bullish. Most of the reports, they need to be up. And so I believe that the crude oil inventories levels were pretty much up last week, so they should be down this week, which should be bullish. So I think Wednesday looks pretty bullish for the most part. Thursday we have the unemployment report, which is it looks like it's going to be a little higher than. Which normally should be, bearish, but again, I think we're going to see more bad news as good news. And it's not really that bad. It's just, it's going to be right around the same. The PPI report month over month for the month of June, it looks like we're going to be up, 0.2%, where the previous was negative 0.3%. So typically this should provide bullish characteristics because it's more than, but, to be determined if it's going to, provide, opposite characteristics. But I wanted to also, I posted some things this morning to remind you kind of where we're at with our stock market and our economic cycle. Because it's always important to know where we're at and where we were at and where we're going. And so this is something that we've been talking about almost every single stock market meeting, and ever since we've been on the market bottom, which was like 6, 7, 8 months ago. And so as we're on the market bottom, we always want to try to focus on technology stocks primarily, but also start watching finance stocks. Finance stocks like Bank of America, Wells Fargo, JP Morgan Chase, these are finding their bottom. And so it's important that we make sure that we're going to get into that. And a lot of people are afraid, because the whole bank issue and going on and the recession, and that's why I wanted to bring this up, because even though the full recession is really right around the corner, but that also means that the early recovery is right there. And so that's why the stock market has been going up this whole time, is because investors in Wall Street and politicians, they know this cycle. This is like their Bible. And so they'll manipulate, the market for financial gains. And right now we have entered the bull market and the bull season. And so it's still saying to focus on technology stocks, but also maybe some industrials and basic materials. So that also means we should be pretty well, our whatever recession that we may or may not be, it should be at its worst. And so there could be a little bit more, but the early recovery is still right around the corner. Once the stock market peaks, and it will peak, usually it peaks right around September. And the reason why is because usually at that time we have a lot of technology reveals. There's a lot, and they're pretty much done usually for the year. Apple will have revealed their iPhones and other devices, as well as Tesla revealing all their stuff or whatever that they have going on. And at that point, technology stocks have priced themselves in. They're at their highest point, most likely for the remaining of the year. And then all of a sudden, after they reveal whatever, usually things go down. And a lot of people are like, why is it going down? This is good news. Well, there's an old saying we have, buy on rumors, sell on news. We knew that this was going to happen. You should have, participated and been aware. And so that's why we don't want to miss an opportunity. And that's why we do these meetings. But once the market has reached its top, that's when we want to get rid of, especially for if you're a long-term, short-term investor, that's where you want to get rid of the technology stocks. And you get into the energy stocks right before the winter season, because during the winter season, we have a lot of traveling. A lot of people drive, they fly due to the holidays. And during the winter season, it's very cold, so a lot of people, warm up their homes. And a lot of them use natural gas, and so this really helps drive the energy stocks up. So for a long-term, short-term investor, if you're swapping out between the technology stocks and energy stocks like every 6 months, your potential gains is like 80% to 100% a year. You could double your long-term investment just by doing this. And so this is extremely important to be aware of this, so that way, again, you can take advantage of what's going to happen before it happens. Now, the cryptocurrency also has its own cycle, where the stock market typically has a yearly cycle, but the economy has a 10-year cycle. Like you remember in 2008 when we had our financial collapse and automotive bailout. Now, I'm sure we were supposed to have something in 2018. However, we had a different president or type of president that was more business oriented. He wasn't really following all the other, Democrats and other, politicians, and so he did his own thing. So that's what kind of delayed the reset of the new cycle. So when it was reset hard with the COVID and economy shutdown in the second quarter of 2020. But with the cryptocurrency, it has a 4-year cycle. And with where we're at currently with the cryptocurrency cycle is right here in the expansion phase. So every 4 years we see from one side to the other. Now the fainted lines, these are years, and so that's where we're kind of right in the middle. This is basically 2003. We're right in here. We just finished the accumulation. We're in the expansion phase, and then during the winter season, we'll be going back into the reaccumulation phase. But that means that the cryptocurrency cycle will reset in the middle of 2024. So we're 1 year away before the cryptocurrency, resets the cycle and enters the bull market. The bull market is a 1.5 year phase. And so it will begin in next year, and then it will end basically at the end of 2025. So if you're holding cryptocurrency, you want to get out right in the beginning of 2026, because it's just going to go down and down and down. But when we're looking at the history of this cycle as well as the pricing, we've noticed that the previous highs become the new lows in the new cycle. So the highs within the current cycle with Bitcoin, for example, was around $70,000. So that $60,000 will become the new lows within the next cycle. So, but with the previous highs, they pretty much quadruple with the next highs in the next cycle. So, if Bitcoin was $60,000 within the highs of the current cycle, 4 times that lets us know that the Bitcoin's price should reach about $240,000 towards the end of 2025 or the beginning of 2026. But then it will drop back down to right around $60,000 to $70,000 at the new low, which will probably take place right around at the end of 2026 to 2027. So this will work just like clockwork, because for some reason it never fails. And so it's an interesting story with Bitcoin. The guy that created it, the person that created it, wanted to ensure it was always going to appreciate no matter what. But how do you get something that's always going to appreciate that doesn't exist? And so that's why he created this event that's called a Bitcoin halving event. Because what happens is they take about half of the Bitcoin out of the system, but they leave the dollar amount there. So what happens when you take half of something out, but you leave the money in there? It doubles. So at the same time, people want to take advantage of this opportunity and they pour more money into it. So that's why it quadruples. And so that's why it's extremely important that we're always aware of the cycle and where we are currently at within the cycle. If anybody has any questions, you can feel free to unmute, and ask any questions that you want. Otherwise, we'll just continue moving forward. And so normally we would go over the scheduled earnings report for this week, but for some reason, Earnings Whisperer forgot to send me our top 10 earnings analysis. I don't know if any of you guys got it. If so, definitely let me know, and that way we can kind of get it in here. But there's definitely some pretty major names on here. The biggest one's going to be our Delta. Delta Airlines is scheduled to release their earnings on Thursday before the stock market opens. And so, and it's not always a good idea to utilize options through earnings. You can before or as well as after. But if we want to go, if we want to utilize options through an earnings event, it's typically recommended to do options on its competitor stock, like American Airlines, for example. With what affects one can easily affect the other. And the reason why we don't want to really utilize options with in earnings, something that's having earnings like this, is because of something that's called implied volatility crush, also known as IV crush. If things don't work out, it can greatly devalue both your calls and puts at the same time. And so that's why we want to do kind of more or less a competitor stock, because even though that, like American Airlines, isn't having their earnings, but it will be affected by the earnings from the Delta Airlines. And because it's affected by another stock, it doesn't get affected by implied volatility crush. And so I definitely plan on straddling American Airlines right before the stock market closes on Wednesday. So that way I have both my calls and puts ready to go for Thursday morning. and some other ones. Looks like we got Pepsi, Progressive on that same day. But we're going to get a lot of bank earnings coming up here pretty soon, and we have to talk about the bank earnings and stuff. I don't know if you guys have noticed, even though our local credit unions interest rates are sky high. I don't know if have you checked yours. They're probably advertising as low as 6.9% or as low as 7.9% or 8.9%. But when you start looking at like these guys, like Capital One or Wells Fargo or whatever, they're advertising lower interest rates, like 5.9%, And so when you're in the market for a car, or something, you're going to try to, do a little bit more homework on who has the lowest interest rates. So basically our local credit unions are suffering more now, and we're seeing that they're buying each other out. They're trying to do things to stay afloat, or even take, people with bad credit, they're going to get creative, and they're struggling right now. And some of you guys could be in the industry. I don't know. Any inside information always helps, but this is some inside information that I'm hearing within the financial system. But if that is the case, we could potentially see greater profit and revenue from these big guys, because now the tables turn. Where before, people would avoid these bigger banks because they had higher interest rates. Now they don't. So just be prepared that the tables may have turned. I just wish we had our top 10 earnings analysis for this week. I'm so upset about that. But I'll try to get it. I'll work with the representatives, and if I can get it, I'll definitely let you know as soon as possible. Some other ones here. So Thursday morning again. What is that? Agera, whatever brands. I can't pronounce that. Is that the company that has the Corona and Modelo? Anybody know? Or is it Constellation Brands? Anybody? So it's important that we know that when it comes to like Budweiser and Modelo, Budweiser is no longer America's number one beer brand, and so Modelo has now become the number one beer brand in the United States, and the revenue is absolutely skyrocketing, according to the inside information. Though we will see here shortly what the revenue will be, but they are saying I think they're up like 20%, 40%, something like that, and the issue that's been going on with Budweiser has helped the beer brand tremendously, and Modelo being now the number one, their revenue again has definitely skyrocketed. So we need to make sure, who has the, what company that they own. I just can't remember if it's this one or the Constellation Brands, but we'll double check here later. So, anyways, and then we have the United Health Group. They're also kind of a big one, not a big mover. But I would say out of all of these ones here, the biggest mover is probably going to be the airlines. So, not sure what you guys think. Any feedback is always appreciated. But let's go into some other things here. Let's take a look at the top 5 things to watch in the week ahead by investing.com. So they're saying basically that the United States inflation data for June will be focused in with the Federal Reserve all but certain to hike rates again later this month. So earnings season kicks off with results from big banks, while data out of China is expected to point to ongoing economic weakness. The Bank of Canada is expected to hike rates again, and oil prices could be poised to break out to the upside. So the number one thing that investing.com is recommending to focus on is the inflation numbers. And that's something that we've definitely been talking about, but they're saying that the data on Wednesday is expected to show that the consumer price index rose at an annual rate of 3.1% in June, which could be the slowest increase since March 2021. The core CPI, which strips out volatile food and fuel prices, is expected to increase at an annual rate of 5%, moderating from 5.3% in May, but still more than double the Fed's 2% target. So they could easily have more work to do, as they say, to increase more interest rates. So the data comes after the Friday's June job reports, all but ensured that the Fed will resume rate hikes later this month. The United States economy added that the fewest jobs in the 2.5 years in June, but persistently strong wage growth indicated that the labor market conditions remain tight. Investors will also get the chance to hear from these several Fed officials during this week with the some of these other Fed. But I also wanted to show you guys the scheduled interest rate hikes. And so when you go to Google, you can just type investing.com interest rates, and it should be the first one that pops up here. As we scroll down, we can see the remaining schedule for this year. And as we can see, we have 4 more interest rate hike decision meetings, though these meetings don't necessarily mean that they're going to increase interest rates, but it definitely means that they're going to talk about it. And we anticipate that they'll probably have at least 2 more interest rate hikes before the end of the year. And so as they had skipped the last one in June 14th, we do have another meeting on July 26th. And it's definitely anticipated that they're going to increase the interest rate again. So if they do that, they could easily pause or skip the one for September 20th, and then they could easily increase the interest rate again on November 1st, and then potentially pause or skip again on December 13th. But to be determined, though it's also anticipated that next year that the interest rate hikes and the interest rate or easing, meaning where they could potentially lower interest rates, they're not going to do that next year, unfortunately. That would absolutely suck. But I hope that they do easing. But I think we're starting to feel that they won't, according to the media and other analysts and whatnot. And I think that they probably won't because of the election. And what we're probably going to see is a lot of these politicians are going to say, oh, if you vote for me, I'll lower interest rates. No, you vote for me, I'll lower interest rates. So it's just going to be a big, it's going to be a big shit show, unfortunately. And so, but, we just got to ride it out. We got to love the volatility because the volatility provides us opportunities. And so, but it's just, again, it's always important to be aware of what's going to happen before it happens. And sometimes we can kind of extend it out a little bit, for the rest of the year. And it's always a good idea to always look at our stock market calendar. That way we're always aware of maybe what's going to happen before it happens. So going into this week, not much other than the short interest release date for Wednesday the 12th. But the rest of the month looks pretty good. I saw this earlier today, which was, and we talk about this every once in a while. It's Tesla's robot that they call Optimus. And so they're showing recordings where it's untethered. And even though it's compared to the Boston Robotics or Dynamics, they're not really focusing on really mass producing that robot, but Elon Musk is. And so when Elon Musk has this robot to a certain point, he's going to say in one of these Tesla reveals, Now you can go to Tesla.com and reserve this product for $100 or $500, and that's going to affect his stock tremendously, because he'll be able to say, oh, we've had these, hundreds of thousands of reservations, even though they won't be able to produce it for several years, down the road. But it will help manipulate the stock and investors. And one of the reasons why Elon Musk wants to mass produce millions of these is to really help, society, and it'll help industries. It'll help people, with their basic day-to-day tasks. It may take jobs like robots have before, but it can also create new jobs. So it's going to be a very interesting situation, but it will be one of the factors that will help Tesla stock continue to appreciate. In our previous meetings, we have detected an $825 call strike price that expires next January. So really, we're about 6 months away, where a lot of investors are betting that Tesla stock could easily reach $800 by the end of this year. But not only could this robot potentially provide that type of characteristic, but also Elon Musk has mentioned wanting to produce a $25,000 Tesla vehicle. Now, if he comes out with a $25,000 Tesla vehicle, now he's opened that market to a whole new type of customer that may have just gotten out of high school, or maybe going into college, or just right out of college. And so it's going to be, it's just going to continue to help his company grow. And he's building a gigafactory in Mexico that I think is scheduled to start production probably towards the end of 2024 or in early 2025. But we've seen what happens when he builds it. Well, just like, for example, just in this last Monday, as I have trying to alert you guys of what was going to happen before it happens, all of a sudden we had a major electric vehicle stock volatility. That was phenomenal. I hope you guys really took advantage of that. But it's really going to help, with more of this. And so, because it's very predictable, and he's always going to reach these huge records. And if you saw what he said last Monday, they were able to achieve over 400,000 Teslas last quarter, record breaking. And so that's amazing. And so but the important thing is we knew what was going to happen, and we were ready for it. And that's why it's important that we always plan our trades and trade our plan, because if we fail to plan, we're planning to fail. And so, let's see here. So with any type of strategy, it's always important to utilize some kind of guidelines and rules to maintain consistent gains and to manage our risk. And so when it comes to straddling, and if you're new to options, we have these two things that's called a call and a put. A call is where we bet a stock goes up. A put is betting against the stock, betting it goes down. And if the stock goes down, your account goes up, which is a phenomenal ability to have with this system. Now, when it comes to straddling is when you have both a call and a put. You're betting a stock goes up and you're betting it goes down. Now, it may seem conflicting. Why would anyone want to bet a stock goes up and down at the same time? Well, it's because you can only lose what you have on one side, but your gains on the other side are potentially unlimited. So it doesn't matter if the stock goes up or down, as long as it picks a direction, it's a winning strategy. But as long as we implement certain rules and guidelines to maintain consistency as well as managing our risks, it will help make the situation more profitable. So with my straddling guidelines, rule number 1 is to always straddle heavy in the top 3 of the top 5 most active stock options. So the best place to get that information from I use a website called barchart.com, and it's free. It doesn't cost anything unless you want to go with their premium. You can, but if we go over to options menu and over the most active options, now we can see what stocks are the most active within the options world. And it does automatically update about every 15 minutes when the stock market's open, and the price changes every second. So this is like our radar. This is our radar. I look at this every single day when the market's open. And so we do not want anything to fly underneath the radar. This is our radar. Even though this is kind of more or less considered a scanner or a screener, this is our radar. It's like being in the military. The stock market is our battlefield. We need to see what's going on. So again, we don't see any enemies flying under the radar. We need to catch every little bit of information or every little bit of activity that's going on. And so, but by focusing on this particular strategy, the top 5 most active stock options for Friday was Tesla, Rivian, Nvidia, Apple, and Alibaba. Now, when we're looking at this regularly, we normally see, our main stocks, and then we normally, but then we can identify things that are not normally on here. And Rivian is not normally on number 2. It's usually somewhere on the bottom of the list, but it is on the list, nowadays. But all of a sudden, boom, it is number 2, when normally number 1 is Tesla, then it goes Apple, Amazon, Nvidia, and AMD. Those are typically our top 5, but I always tell people this could easily change. It's like an athlete in any sport. All of a sudden, an athlete, you have a number 1 guy or woman for a certain amount of time. It could be 1 year, it could be several years or whatever. But eventually, a new athlete will come out, and it'll be their time to shine. I've seen this happen, over the years. And but just don't get attached to any particular stock. Don't fall in love with any particular stock. Don't favor any particular stock. Just focus on the rules and the guidelines. And because what if Rivian is now the number within the top 5? Regularly now. I mean, this could just be a little fluke, but what if it's not? That could easily change, especially as it's building up momentum and its price. But we can see with Tesla, it had 2.6 million in options volume last Friday. But out of that options volume, 61% are betting on calls, betting that the stock's going to go up, where almost 39% are betting against the stock, betting it goes down. Now, a lot of this is going to be also straddling activity. And this could also provide you that maybe a straddling ratio, because most of the time I'll go 50-50. 50% on calls, 50% on puts. But I do have a certain personal limit where I won't go any more than 60% on one side while 40% on the other side. In case things don't work out, it still gives me something to work with that I can still create profit for the day. But if you go more than that, like let's say 70%, 30%, if things don't work out, it's going to be a lot harder to work with that 30% to recuperate the loss that you may have gotten on the other side. And so that's why you want to try to maintain that a good balance. But if you're learning, stick with 50-50, 1 call per 1 put. But if you're doing it like a 60% on one side over the other, that would be like having 6 calls and 4 puts, or you can do 3 calls and 2 puts, minimum, to try to stick with that 60-40 ratio. Because a lot of pro traders have this saying, always follow the money, and so this is part of that. We're following what's going on. Where are people putting their money? And obviously it was definitely a very strong technology day with Tesla, Rivian, Nvidia, Apple, and Alibaba. But a lot of times we can also identify unusual activity like stocks that aren't normally on here, or maybe there's just a really whacked out ratio. Like for example, NEO or Alibaba, which both are Chinese stocks. And but both have 80% calls while 20% puts. Now we could potentially utilize maybe like a lottery play. A lottery play is where high risk, high reward. Where the straddling strategy is more or less a low risk, high reward, which is what we want. But occasionally, if we have a little bit of money, we can throw at a high risk, high reward scenario. Maybe we can throw some calls right before close on these types of higher percentage ratios. Even here, we have Lucid, which was up only 5% Friday, and it closed at $7.45. But Lucid almost closed at 84% call ratio. This is almost unheard of. Normally, we see about a 60-40 ratio, maybe 50-50. But as we're really going gung-ho in the bull market, we're going to see a much higher call ratio because majority of the time the mornings are going to open in the green. And so investors know that, and that's why now we're seeing a higher call ratio now than we did last quarter and the quarter before that and before that. If we go to the options volume leaders, now we can see the most active individual calls and puts. But when we're looking at that, we want to make when we're looking at it during the weekend or Friday, we want to make sure we're avoiding anything that's going to expire or has expired. And the best way to look at that is looking under the DTE, which represents the days until it expires. It says 0. So the expiration date is already passed. So we want to avoid that. So by focusing on the ones that are current, we can see that we have a Tesla call. Now Tesla, which finished at $274, we have a $280 call strike price that expires this Friday. We see that the open interest has only 11,000, which if you're new to options, open interest is basically the total number of open contracts that have been traded but not yet liquidated via offsetting trades, meaning that people bought it prior from Friday that have not sold it yet. So these are people holding. Now when you see volume, knowing volume is always the current day's buying and selling activity, all of a sudden we have 87, almost 88,000 in pure buying activity because it exceeds the open interest. Now if the volume was less than the open interest, then that kind of makes us wonder, is it mostly buying activity, or is it selling activity, or is it just a blend? But when we see the volume that greatly exceeds the open interest, now that means that it has more interest and people have bought it. And so, especially right before close on Friday, is telling us that investors are anticipating that Monday is going to open in the green. Because if they were anticipating it was going to open in the red, they'd be buying puts, not calls. Though we do have an Apple put right here. Which still has a lot less volume than the Tesla at 56,000. Open interest a little more than the Tesla open interest at 24,000. So we do see there that, but we do have a call on Apple with 48,000, almost 49,000 in. So it looks like that we're seeing more straddling with Apple. Those type of investors are probably not taking any chances. No, they're like straddling, but no, they seem to be very bullish with Tesla on Monday morning. And this information is available before it closes, and that's why it's highly critical to use this for your advantage throughout the market hours. That way we can identify who's buying what and where. And so, but going down the list, now we have a Nikola, which Nikola is another EV, a company that had a lot of lawsuits, a lot of issues because they weren't doing things right. And so, but I feel that they could. I think they're overcoming a lot of these legal obstacles, and they may be ready to move forward. And we're seeing more and more activity betting that they're going to keep going up. And we do have a $1.50 call strike price that expires here in a couple of weeks, and there's a lot of volume and a decent amount of open interest that will soon merge with each other. Now, NU, someone in the group or chat room also mentioned something about NU, and I think that is it's a Chinese scooter or motorbike, all electric, company, and so it looks like there's more betting on the upside on that one. Let's see, Apple call, Rivian. There's a $25 call on Rivian. There's a $40 call. Now look at that, you guys. And even if you don't want to be into stock options, that's fine. But still, I highly recommend looking at this information, because as a short-term or long-term investor, even if you don't have time to actively trade, that's fine. Still, it's important that you got to look at this, because we always want to follow the money, even if you're a short-term or long-term investor. So, for example, if you're a short-term, long-term investor, you buy Rivian, even at $25 a share, it goes to $40 a share. You just made, 70%, 80%? Just from that in a very short period of time. These investors are betting Rivian are going to reach $40 by sometime in this September, or approximately 69 days from now. We can see that they had 28,000 in open interest, and now we have 44,000, which exceeds the open interest, which means it's got more interest. People are buying it, betting that Rivian's going to go up. It's time, and especially with all the reports that we've gotten and the infrastructure and everything else that's going on with the EV market. I'll throw this in here too. We watched several years ago, the governor of Hawaii implemented a deadline. By 2035, all brand new vehicles sold in the state of Hawaii are now required to be all electric. Well, then we watched the governor of California say, "Oh, that is a great idea. How come we didn't think of that? Let's implement the same deadline. 2035, all brand new vehicles sold in the state of California is all required to be all electric." Well, then other states started doing it back east, and I'm in the state of Washington, in the Pacific Northwest, and our governor was like, "Well, this is a great idea. Let's beat them to the punch. Let's do it sooner. Let's implement a deadline by 2030. All brand new vehicles sold in the state of Washington are now required to be all electric." So there's so many things that are going on so fast. Even like Ford Motor Company, they have this deadline by 2024. They're going to this next level with EVs and stuff, and I'm sure other manufacturers are doing this too. And a lot of this stuff, there's just a lot of inside information that a lot of even the public isn't even aware about yet. So just be ready. There's a lot of stuff that's happening when it comes to the EV market. Even the government is investing into 20 different mining companies around the country, and they're getting ready to build infrastructure or charging stations. But the one question we all have is, where are they going to get the electricity for this? That's still kind of mind-blowing. I know that scientists are working on fusion energy, but we've heard Elon Musk's interview and comments on that. We're still years away, and it's still so much effort that you have to put into it versus solar energy. The sun provides us free energy. We can easily manufacture very efficient components to absorb this energy that we can just kind of harness, but no. So look at this, you guys. Tesla, which again is currently $264. We have a $385 call strike price that expires this August 18th, approximately 41 days from now. 26,000 open interest. We have just under 44,000 in brand new fresh volume, which these two are going to merge tomorrow. Man, but again, we have detected, I don't see it on here now, but I'll refresh the page with a different configuration. But in the past, we have seen an $825 call strike price for Tesla that expires next January of 2024. But this is the first time we've seen this one, $385 that expires in August, which is very, very interesting. So again, as we've talked a lot about Tesla and the potential of them revealing a $25,000 electric vehicle, as well as taking reservations for this robot, we can easily see Tesla pricing in that stock before those reveals happen, because maybe investors are anticipating it's going to happen. However, one thing we don't see is greater activity for Apple. And I do have to remind you guys, as I do remind, that Apple is getting in the car business. They are coming out with an electric vehicle, which I have a very interesting story on that one as well. Many years ago, Tesla has always been on the verge of bankruptcy. He was just stressed out, always had to live at the factory, blah, blah, blah. And so one day he wanted to work with Tim Cook with Apple. And they had lunch together, they had a meeting, whatever. And so Elon Musk says to Tim Cook, he goes, Tim, people love Apple, people love Tesla. Let's do something together that'll help benefit both our customers and our companies at the same time. Well, Tim Cook, pulls out his phone and he goes, Elon, we specialize in phones. That's what we do, and that's what we're going to stick with. Well, at the time, all of a sudden, Apple starts getting these lawsuits because they were manipulating people's batteries, because or their phones. They would slow down their Apple phone, blaming it on the battery degradation, and so that way. Once your phone's battery degraded to a certain point, all of a sudden the software would automatically go in like some kind of limp mode. And so it would cause you to be frustrated to the point where you would want to go and buy a brand new phone. And so they got a big lawsuit on that. And especially after they build this new headquarters somewhere in California, now they're like, they see a decrease in revenue later on down the road. So they need growth. 70% of the revenue is coming from the iPhone. You can't just, that's very, very risky to be relying on just one, product. And so, but after a while, once Tesla and Elon Musk finally became a profitable company, very, very successful, all of a sudden Tim Cook gave up and he said, guys, we decided we're getting in the car business. And I think that was right around like 2019. But when a company like that kind of reveals that kind of information, well, we usually see something after a couple of years, which should have been 2022. But because of the pandemic in 2020, that most likely delayed a lot of stuff. And so in this case, if it delayed this for 1 year, that means we should see Apple reveal this electric vehicle this year. And hopefully, Tim Cook will say, just like what Elon Musk usually says, and now Ford Motor Company, when they reveal something, they'll say, now you can go to Tesla.com and reserve this vehicle for, well, it used to be $500. Now, like with the Cybertruck, it's $100. So hopefully it'll probably continue that. And so if Apple says, now you can reserve your Apple EV vehicle for $100 or $500, it's going to be a huge game changer. Apple stock is going to surge like crazy because now they've done something different that they haven't ever done before. And where normally when a reveal happens, the stock goes down because it's anticipated that they're going to do that. Well, we don't see any activity yet in the options world that Apple's going to do that because they probably haven't leaked anything, or maybe it's been so long that investors have forgotten about this. Well, I'm not forgetting about it. I hope you guys don't either, because it's inevitable. It's going to happen. It's going to happen. It's not a matter of if, but when it's going to happen. And I believe it's going to happen this year. If you've ever watched Apple's reveals, and if you remember the iPhone X, that day he was talking about the iPhone 8. The iPhone 8, small, the large, medium, the iPhone 8 colors, blah, blah, blah. They went over the iPad, this and that. And all of a sudden it looked like the show's about to end. But all of a sudden Tim Cook says, but wait, there's more. we have a surprise for you. And all of a sudden, this iPhone X comes out, completely redesigned iPhone. Even though they skipped iPhone 9, they went straight for the iPhone X. But we weren't expecting that, and so we could easily see Tim Cook do the exact same thing. So just be ready. This could be the year for that. Even though there's been some issues in the last 3 years, this should be the year, and hopefully it is. But yeah, Tesla, man, $385 by this August, and possibly even more in September if Elon Musk surprises us with some phenomenal news. Alibaba, which ended $90.55, we got a $95 call strike price that expires this Friday as well. A lot of volume on this guy. So if I sort this out by open interest, I'll refresh the page really quick. That way it refreshes the whole system by the highest open interest. Now we see a lot longer expiration dates because people are holding on to these individual ones a lot longer. AMC, which is a manipulated stock, is definitely recommended to avoid any manipulated stocks like those in GameStop. Nikola, we do have a put there, though it could be selling activity. Who knows? Because the volume is definitely less than the open interest, but it's still up here and it's showing a lot of activity. So we'll have to see kind of what's going on there, and then. But if you're a short-term or long-term investor, you still want to kind of look at numbers that are greater. A great distance between each other, while avoiding manipulated stocks. And here it is, you guys. Tesla call $825. Don't take my word for it. The proof is in the pudding, you guys. It's right here. The numbers don't lie. $825 call strike price that expires this January 19th, approximately 195 days from now. It's accumulating more and more open interest. A little bit of volume because nobody knows about this. It's flying underneath the radar, but it's not flying under our radar because we can easily see everything that's going on here. So that is a huge, so if you're, short-term, long-term investor, you definitely want to buy that because it's about to triple or even quadruple. But as we talked about earlier in this meeting about our stock market cycle and economic cycle, do you guys remember when we need to sell our technology stocks? Right before the winter season, because technology stocks always go down during the winter season. That's when we want to focus on the energy. Get in, get out, repeat the process. Anything else in here? Let's see. No, I don't really. Oh, wait. Alibaba, you guys, look at this. Alibaba, which is currently at $90.55. We have a $200 call strike price with the same expiration date. Next January 19th, approximately 195 days from now. It was never on this list before, and now it is with growing open interest. People are buying and they're holding. This has been a great list, you guys. Any questions? Feel free to unmute your mic, or if you guys have anything to share, definitely, or we can screen share too. Let me see if there's anything else. Oh, I still have to remind you guys, quantitative tightening is not over. I'll mention it every once in a while, and people are like, oh, I forgot about that. Though quantitative tightening, the amounts have, even though they've been reduced, but over the last, recently, but they're starting to kind of grow a little bit bigger. But we should be entering a time period soon here, the next several months, where it'll be a weekly event, not a twice a week event. So by looking at this, and if you're not sure what quantitative tightening is, a lot of times when you're listening like Bloomberg, Yahoo Finance, or whatever, whoever, they'll refer to QT. You may be confused on what QT is. Again, it is quantitative tightening. That is when the government is selling the stocks that they bought during quantitative easing. Now, quantitative easing last took place when the government closed down the economy during 2020, during the second quarter. When they closed the second quarter, they knew that this was going to happen. They created this massive rock bottom, and they initiated quantitative easing. They bought stocks on just record-breaking low prices, especially oil. We watched oil go down less than a penny. In fact, oil went in the negatives. I've never seen anything go in the negatives, because normally when something goes under a penny, it's a fraction of a penny, not in the negatives. And all of a sudden, it went into negatives, and the government started buying oil for nothing. And now they're selling for financial gains. Now, for Tuesday the 11th, this is basically saying that they have scheduled to sell about $2.5 billion worth of stocks, which really isn't enough to really, really do anything with the market, because people will easily put that money right back into the market. However, with Thursday the 13th, we have it scheduled for $15 billion worth of stocks to be sold. That's a little more difficult to try to recover. But again, we are in the bull market, in the bull season. So you can easily have other, millionaires and billionaires pour that money right back into it. But still, $15 billion is a lot. When you're looking at the rest of this list, there's only a couple of those here, not very many. And so what was the economic reports on Thursday? So Thursday, unemployment goes up, PPI report goes up, which is a monthly report. So this could provide that good news is bad news thing, because this is saying the economy is doing good, and but by trying to increase the interest rates, they're trying to get the economy to do bad, not good. And so this is where we get the good news is bad news. So both of them are scheduled to be reported at the same time. And so the quantitative tightening could be executed at any time that day. It could be executed during pre-market. It could be executed during the market hours. It can also be executed during after hours, even at the last second, which you don't even really get to see it take place, because at the last second, it doesn't really affect the market until the next trading day, which would be Friday. But because if they did it that way, and bleeding into the next day kind of absorbs the impact. It absorbs the blow, so it's not as volatile. But I would hope that the government would execute this during, right around this time, because it's basically like pouring fuel on the fire. It's making the situation more volatile. Plus, if they execute it during this time, 1 hour before the stock market opens, they'll just blame it on the economic report. That way, the quantitative tightening doesn't make it so obvious. You see what I'm saying? So hopefully that makes sense. So don't forget about the quantitative tightening, because it's not over until towards the end of this year. Let's see, what else? Anybody? Let me see if there's anything else in here. Oh, so I did want to go over this too as a reminder, when to trade based on your strategy. So a lot of people are always kind of wondering, best times. No, the bell traders take advantage of the quick movements in the first 30 minutes of the day, and which is one of the reasons why we utilize the straddling strategy. Rule number 1, always straddle heavy on the top 3 to top 5 stock options, because not only are we utilizing the top 5 stock options list to help provide to give us the answers on which ones to use, but the bell traders, where they take advantage of the quick movements in the first 30 minutes of the day, sometimes could be the first hour, because you've noticed that sometimes an economic report comes out 1 hour after the stock market opens. So we want to be, and we want to be aware if it's going to provide that bearish characteristics or bullish characteristics, because maybe we want to hold for just a little bit longer after that 1 hour. Because now we have the breakout traders. Watch for the momentum breakouts in the first few hours of the trading day. But the only way we're going to know is there going to be a breakout is by knowing the economic reports. Because the breakouts aren't just going to happen just from nothing. They happen because of something. And they usually happen because of some kind of, economic report for the most part, or some kind of news, and usually the news is the economic report. So it only makes sense that if you haven't already mastered economic reports, that you do this now. In order to get different results, you have to try something different. Otherwise, if you keep doing the same thing, you're just going to get the same results. So it's important to grow, to learn, because the more you learn, the more you're going to earn. And so rule number 2, strike price always at the share price. And the reason why that is because we want to have the least amount of depreciation. If you pick a strike price that is beyond the share price, the system may think that it may not reach that, and it's going to provide it more time decay, and you're going to lose more value. If you pick a strike price that is right at the share price, it's going to maintain the value without depreciation or very little depreciation, because it's waiting to see what happens. And so we want to maximize this strategy as much as possible for our benefit. And the way to benefit that is by trying to have the least amount of time depreciation as much as possible. So rule number 3, always the soonest expiration date for the most volatility. Now, when you look at expiration dates, if you pick one that's a lot later in the future, not only is it going to be more expensive, but it's going to be a lot less volatile. So when you're straddling with a later expiration date, you may gain 20% on one end, but you may have lost 20% on the other end. So you're always at a wash. You're not really, it's harder to profit that way versus having a sooner expiration date. There's more volatility. And that's what we want. That's a key ingredient to straddling, because with a worst case scenario, like let's use Rivian as an example. I'm gonna pull this up here because Rivian was up about 14%. So let's dig into the options area here. Let's see, I can't really increase that there. Okay, so Rivian's right here, you guys. So the Rivian price is in the middle. Hopefully you guys can see that. The calls are on the left side. The puts are on the right side. So let's say if you were to bet, or let's say if you're going to straddle Rivian, you just gained 300% on one side and you just lost around 60% on the other side. You see how this can easily benefit you. It doesn't matter if the stock goes up or down, as long as it picks a direction. Your gains are unlimited. Your losses are only what you put into it. And so your gains will always outwash your loss, and it puts you ahead. And that's why we want to get in and get out and repeat the process on a daily basis. And so, but if we select a later expiration date, there's less volatility. Now, like I just picked August, now we see that the calls have gained 160%, and the puts are down about 30%. That's still pretty good, but normally it doesn't work, quite like that, because usually, we don't see 14%, price movements. But you can see the later expiration date that you go with, now the less volatility that it gets, and the more expensive that that it's going to cost. So it'd be better to go with the sooner expiration date for the most volatility, so you can maximize your gains. And that is why we have rule number 3, always the soonest expiration date for the most volatility. But to an extent, we don't want to get the same day expiration date. I don't really recommend getting the next day's expiration date, because if there's no price movement, then you could potentially have the call and the put depreciate. It could be 5%, 10%, whatever. We don't want that. We want to be able to gain on one side and a little loss on the other side. And so if we're on a Thursday, I would get next week's Friday's expiration date. That way we have a week span within a 1 week. We just don't want to go beyond 1 week, like 2 weeks, because now we're losing some volatility and spending more money than what we should. Unless you're maybe a high roller, then you maybe want to be in the money, because if you're a high roller, you don't want to have like hundreds of contracts, because the contracts then get executed in spurts, like 10, 5, 20, 30. And if the price changes, then all of a sudden, now your execution has stopped, or it's pending, or partial. It's a partial execution. And now it's waiting, and then you have to go back in there and edit it or modify it and start over, and it's a pain. So as a high roller, you want to have you spend a little bit more per contract by being in the money, deeper in the money, and having less contracts. That way, when you're buying or selling, you have less contracts that will execute. So hopefully that makes sense. Rule number 4: buy our straddles, I'd say 5 to 10 minutes before close to sell the next morning within that first hour. Now, if you're really good at executing your orders pretty quickly, I usually recommend 5 minutes. But if you're pretty slow and fumbling through your application, you want to give yourself more time. And that's where 15 minutes at max it would be recommended. But if you're quick and you can execute your order within a few minutes, 5 minutes, 10 minutes, that's perfect. But once you start getting really good at straddling and moving averages, now we can buy and sell our calls and puts at different times. That way we can provide more gains and minimize our losses. Like, for example, in the morning, if the stock had opened and we can. And we can always, sell our put if it's going to go up and hold on to our call, and then we can sell our call, with the right signal. And so that's where we can really maximize our gains. Or if you're new, you can just buy and sell at the same time. Don't worry about buying and selling at different times. Those are pretty much for more experienced traders and investors that are more fluent with the moving averages and indicators. So rule number 5, avoid earnings and splits. Unless it's a lottery play, invest very lightly. But when it comes to our primary strategy, we invest heavily. But lottery plays are those high risk, high reward scenarios where just like a lottery ticket, you can invest a little bit of money into Mega Millions or Powerball, but you're not gonna put a fortune on there. You're just gonna put a few dollars or a few bucks, whatever, on there. But if you win, you'll win big. But you're just gonna but the only way you're going to win is to play, so that's where a lottery play comes in, where we put a little bit of money into it. If we lose, it's money we're not going to worry about. It's just something we just forget about it. But the heavy stuff is the ones that we have a lot more control over. Rule number 6, avoid straddling throughout the day or the middle of the day to minimize the time depreciation. And because usually the middle of the day, it's flat. It doesn't do anything unless there's a breakout due to a phenomenal economic report. But for the most part, the middle of the day is the range traders. The range traders identify midday support and resistance. They get in and they get out. They really quickly, they just take advantage of that because it's not doing anything. It's just going up, down, up, down, up, down. But it's ranging flat. But when you're holding on to options, that's death. That's time depreciation. It's going to depreciate both your calls and puts. This is the area we want to avoid. This area here is fine. Bell traders, breakout traders, reversal traders, when it comes to the straddling, whatever, stock, but range traders, that range in the middle of the day, but we want to avoid that closing bell. That's another great opportunity for those that can utilize moving averages, where traders take advantage of the market movements near the end of the day. Otherwise, just you buy your calls and puts 5, 10, 15 minutes before close, get in, and then get out during the bell traders, or within the first hour, or even the hour after that, depending on what's scheduled to happen. But if there's nothing scheduled to happen, get out within that first hour, even if it's at a wash. It's like avoiding a fight so you can live to fight another day. It's to live to trade another day, because most likely the next day will be better, more volatile. I definitely straddle on a daily basis, and you just don't want to have your emotions affect your buying and selling decisions. This is a process that should be stuck, as a process. Don't be hopeful. Just, get in, get out, and this will change your life forever, as it has mine. Let's see if there's anything else. Anybody else have anything to share? Any questions? Anything you guys wanted to go over? You guys need help with anything?
Carlos, I have a question.
Yes.
How you use MACD for trading, and also how you gonna use moving average? Let's say stock market is going up and one point is going down, but how you gonna use this thing for trading?
So the MACD, let me try to configure my screen here for you. So let me make sure my extended hours is on. There we go. So this is Tesla's stock. Are you more of a short-term investor, or long-term, or are you day trading, swing trading? What type of investing do you prefer?
I actually prefer that day trading.
Day trading. Okay. So both the moving averages and the MACD are the most common, most popular indicators that professional investors and traders use. And both of them will kind of communicate with you. And the key thing to knowing your indicators is basically your crossover signals. When the moving average lines and the price line crosses over each other, that's letting us know the trending direction. Like, for example, so this is Tesla. The pre-market is during this area here on the lighter area. The market opened right over here, and we can see that all of a sudden Tesla stock opened going down. So while holding our calls and puts, we're waiting for a signal. We're waiting for it to tell us to do something. So as it goes down, it's basically telling us, get ready to sell your puts. Now the MACD right here, the MACD is basically two moving average lines. There's no price line in the MACD. There are two moving average lines, one slower than the other. But these red and green lines are gap distances between the moving average lines. So it's very weird how it works, but once you know what these are, all of a sudden this light bulb goes off. You're like, oh, okay, And so the red and going down is letting us know it's downtrending. Now all of a sudden the moving average lines on the MACD has crossed over each other, and we're starting to see green. So a lot of times the MACD will provide us a warning or an alert before the price changes up above. And so you'll see that it crossed over here before Tesla's stock price changed, and we can see a pattern here. This is basically the double bottom pattern. I don't know if you can see that or know what it is, but I'll draw it off here. This is a double bottom pattern right here. We see two bottoms here, and which is telling us it's going to go up. Well, the MACD is also telling us, hey, be ready. The price is about to go up, and all of a sudden it does. And all within the first hour. So we sold our puts, holding on to our calls, trying to get it to recover or whatever, just to maximize our gains or minimize our losses. And now we can start, then we can sell our calls here, which would have been a lot better than selling the call down here. So this is where it's kind of telling us to do these things. But after the first hour, we want to switch between the 1 minute to the 5 minute graph, because things start to kind of get a little weird after 1 hour. So if we try to smooth it out with a 5 minute graph, now it looks a lot better. So as you can see that here's the dip where we sold our put. We're holding onto our calls, waiting for that indication. And here it is, right here, where the price line cuts through the all three moving average lines, providing us that downtrending signal. And the MACD was trying to tell us that what it was going to do well before that happened. It said here, well, but it could have been, but you could have sold there versus here. Most likely the value would have been the same. If not, maybe there would have been a little more depreciation here than it would have been over here. So I would have sold here and just been done with it, and then buying the calls and puts again right before close. So hopefully you can kind of see that a lot clearer now. And if you need help modifying your graphs and charts, screen sharing within our meeting is available. So that way, if you need help, I can help you guys configure your charts and graph accordingly to your style in investing and trading. Does that make sense? Well, hopefully it does. Can't hear you. You'll have to unmute your mic if it's muted. But yeah, hopefully that makes sense. Anybody else have any questions or wanted to go over anything?
Yes, Carlos. So you actually you recommend that we have to use 5 minute chart all the time, or you just use the 1 minute chart for day trading, especially in the morning time?
So you can do both as well. You can do a split screen, but it's typically recommended to use the 1 minute chart and graph within the first hour, because after the first hour things start to get just kind of a little weird. It doesn't really I don't know, it's kind of weird. But if you switch between the 1 minute to the 5 minute graph after the 1 hour, after the first hour, like I said, it smooths things out, and it makes it easier to read. And it's easier to read if you zoom in, because we need to see exactly what's going on. And that's one of the reasons why I don't use candles, because I like a clear picture. I'll switch to candles and see what it does here. Then boom, look, it's like blurry. It's like, to me, it's like drunk vision. I need to see exactly what the price line is doing, rather than all this information, because it's just so much and overwhelming that it just clouds the moving averages. And that may be why it's kind of designed to do that, is to kind of help confuse people because of that. So I don't like that. I want a clear picture of what's going on, so I use the lines, and I can see exactly where the price is and where it's heading. And
Carlos, 1 minute is more faster than 5 minutes. Because,
correct.
Within 1 minute and 5 minutes, things can change like a lot. So sometimes it look like that MACD is cross over the signal line in 1 minute, but 5 minutes it shows that it's actually going down. So that's why actually you're confused. I mean, what is it actually going to do with these 5 minutes and 1 minute?
Yeah, because the 5 minute it kind of holds the majority after the first hour, but the 1 minute, yeah, it can look like it's going down. Like right here, it looks like it's going down. The MACD does. This is what's kind of considered a false signal. We don't want to be fooled by a false signal, and that's why we want to switch after the first hour between 1 minute to 5 minute, because the first hour, I mean, there's a lot less false signals within that first hour. But that's why we want to try to listen to both, because both of them are kind of communicating with us, and we want to try to listen to both of them at the same time. hoping that they'll provide us the same signals at the same time. Because yeah, one may say one thing over the other, and that provides a lot of confusion, frustration, but as well as doubts. But we want to make sure like all the stars are aligned and both of them are kind of providing the same information.
And this is actually the scalping is the better thing, I think, for 1 minute or 5 minutes, 1 minute chart. And in between 1 and 5, actually, I use sometimes 2 minutes or 3 minutes is much more clear, in my
Yeah.
opinion. So
Oh, definitely. Especially scalping. If you're like getting in and out really quick within like a minute or a couple minutes, 1 minute chart definitely all the way. Day trading, you definitely want to go with the 5 minutes, because if you're doing a day trading where you want to get in and out, all of a sudden you can buy on this dip, and then you get out over here and you're done and over with. And then you go and then you look at the next day, or you can do another day trade because you can buy a call here, you sell the call here, buy a put, sell the put here, and then or you can do your straddling or whatever. There's just so many great opportunities that you can do, but it's very important that you know when to use these graphs and what kind of settings to apply them to.
which kind of settings you recommended for Webull? Actually, I use the Webull for the charting and Robinhood for the execute the option. So
Yeah, and that's amazing because and especially when you want to use a couple different devices, because I don't like executing or using everything on one device, because it's like turning your back on the ocean. All of a sudden you can have this big wave and you're not looking. And so by utilizing your phone for Robinhood or Webull to execute your orders while looking at a tablet, laptop, or desktop, you're keeping your eyes on the target, and then you're utilizing another application or something on your other device. And so, but indicators, there's so many different ones, but I use EMA because EMA, or exponential moving average, is more reactive to price changes. And so, especially if you're scalping or day trading, you want a more reactive moving averages. That way you can take advantage of what's going on before it's too late, and you're losing out on on certain movements. So you want more of a reactive moving averages, and that's where EMA would be the best moving average for that. But also utilizing the MACD along with it, they'll both communicate with you to let you know what's about to happen with its trending direction.
and also you will never recommend that play against the trending, because sometimes this is actually fake out. Sometimes the lower low or higher high, and this is actually more confusion when you're day trading. So can you do something else about this thing?
Say that again.
That do not play against the trend. Let's say it's going to downtrend, but sometimes the market is going up and all of a sudden it's going down again. And same thing happens when you do the trend is changed, look like it's going up, lower, but actually not. It is going higher. So this thing is actually you recommend that for to see the trend line for lower low and higher high, something like that.
Well, and sometimes the MACD can look like that. If the share price is just kind of ranging flat, the MACD kind of starts going down, and you start getting this red and down, kind of down trending, even though the stock may have kind of flattened out. All of a sudden, yeah, it could go up, even though the MACD. And that's why we want to make sure, we're putting all the pieces of the puzzle together. All the stars got to be aligned. And but it's just important to really focus on this rather than certain price targets or highs of the day, lows of the day, because obviously the lows can get lower. The highs can obviously get higher, but that's why we want to make sure that we're really following the information that these indicators are providing us. Because we could get false signals, and that's why we want to identify false signals and try to avoid those by maybe changing our graphs a little bit between the 1 minute, 2, 3 minute, or 5 minute graph. Usually the most popular ones are going to be your 1 minute and the 5 minute graph. But again, the majority of the plays should be the straddling strategies, getting into other things, day trading and stuff like that, and just light stuff, here and there. Pick something that's pretty volatile for the day, but yeah. Any other questions?
Not so far right now. I'll let you know if I have anything.
Absolutely.
Thank you so much, Carlos.
Anybody else have anything to share? Anybody bring anything to the table? Have any questions? Everything makes sense? Are you guys ready to rock and roll?
Yes, sir. Thank you so much.
All right. Looks like we're good today. Thank you guys for joining our meeting. I will be in the chat rooms. If you guys have any questions, please don't hesitate to let me know. Other than that, if I get our earnings analysis this week, I'll share it with you guys and let you know. Anyways, have a great Sunday. We'll rock and roll, and we'll make lots of gains this week.